This is why you need diversification. Investing is important for growing your money. Whether you're just starting or you've been investing for a while, understanding the basics is really important. But investing always has some risk. Markets can change quickly and prices can go up and down unexpectedly. So how can you protect yourself while still aiming for good returns? The answer is having a well-planned strategy. And that strategy is diversification. Diversifying your investments means spreading your risk. Think of it like this. You don't want to put all your eggs in one basket. This means investing in different types of assets. By spreading your money across different investments like stocks, bonds, real estate, and even things like gold, you're less affected by market ups and downs. If one investment loses value, the others can help balance it out. For example, if the stock market drops, your investments in bonds or real estate might stay the same or even go up. Diversification helps you sleep well at night, knowing your money is growing safely. It gives you peace of mind because your portfolio is protected if something unexpected happens. In this video, we'll explore different asset classes and how to combine them to create a strong portfolio that matches your goals. We'll talk about the good and bad of each investment type and how to balance your portfolio to get the most out of your returns while minimizing risks. Stop putting all your money into just one company. Do this instead. Imagine doing that. You're putting all your eggs in one basket, hoping that this company will do really well and make you a lot of money. If the company does well, you'll make a big profit. You'll see the value of your investment go up quickly. But if the company fails, you lose everything. Just like that, your savings could disappear. That's where diversification comes in. Instead of betting everything on one company, you spread your investments across many different assets. By investing in a variety of assets, you spread the risk. This means that if one investment doesn't perform well, the others can make up for the losses. Assets are grouped into classes, and each class has its own level of risk and potential return. For example, stocks can offer high returns but are more volatile, while bonds are more stable but offer lower returns. The main asset classes are stocks, bonds, real estate, commodities, and index funds, ETFs. Each of these classes reacts differently to economic conditions. Each reacts differently to economic changes, providing protection against significant losses. For example, when the stock market is down, real estate or commodities might still perform well. By diversifying your portfolio smartly, you create a safety net for your savings while maximizing your potential for long-term growth. This allows you to navigate the ups and downs of the market with more confidence and stability. Why are there not more people talking about the true potential of investing in business growth? Stocks represent a share of ownership in a company. When you buy stock, you become a part owner of that company, which gives you a claim to a portion of its profits and, in some cases, voting rights at shareholder meetings. When you buy a stock, you are betting on the future growth of that company. You hope that the company will grow, increase its revenues and profits, which will drive up the price of its stock in the market. Stocks offer the potential for high returns, but also come with a higher level of risk. Market fluctuations can be unpredictable, and past performance is not a guarantee of future results. If the company performs well, the value of your stock increases, and you make a profit. Dividends may also be paid, providing an additional source of income. On the other hand, if the company faces difficulties, the value of your stock may decrease. Losses can be significant, especially if the company goes bankrupt or suffers major financial setbacks. Stocks are therefore considered a long-term investment, as short-term fluctuations can be significant. By maintaining a long-term perspective, investors can better manage periods of volatility. It is important to remember that the stock market is cyclical, with periods of ups and downs. Understanding these cycles can help investors make more informed decisions and better navigate the financial markets. You need to hear this if you're an investor looking for stability. Unlike stocks, bonds represent a loan that you make to a government or a company. When you buy a bond, you are lending money to the issuer for a set period at a fixed interest rate. At the maturity date of the bond, the issuer repays the principal amount you lent them, plus the interest. Bonds are generally considered less risky than stocks because they offer a fixed income. However, their potential return is also lower. Bonds play an important role in diversifying a portfolio by providing some stability against stock market volatility. You need to watch this if you struggle with understanding how owning a roof over your head can also be a smart investment. I bet you didn't know that owning a roof over your head can also be a smart investment. You need to hear this if you're an investor. Commodities are raw natural resources, such such as gold, oil, natural gas, wheat, and coffee. Investing in commodities can be done directly by buying the physical commodities or through futures contracts. Commodity prices are influenced by global supply and demand, as well as geopolitical factors. Commodities are short-term, but they offer interesting diversification within a portfolio because they tend to move differently than stocks and bonds. You need to watch this if you struggle with understanding how to diversify your investments. Index funds and ETFs, or exchange-traded funds, are investment funds that track the performance of a stock market index, such as the S&P 500. Investing in an index fund or ETF allows you to invest in a basket of diversified stocks or bonds with a single investment. These funds are passively managed, which means they have low management fees. Index funds and ETFs are a great way to diversify your portfolio easily and cheaply. They allow new investors to enjoy the benefits of diversification without having to select each stock or bond individually. I bet you didn't know how crucial it is to define your financial goals before investing. Before you start investing, it's crucial to clearly define your financial goals. What do you want to achieve with your money? Do you want to buy a house, finance your children's education, prepare for retirement? Defining your goals will allow you to determine how much you need to invest, the time horizon of your investments, and the level of risk you are willing to take. Clear goals will help you stay focused and motivated throughout your investment journey. You need to hear this if you're an investor. Your risk tolerance is a crucial factor to consider when building your portfolio. Risk tolerance is how comfortable you are with the ups and downs in the value of your investments in order to potentially earn a higher return. If you are risk-averse, you will prefer more stable investments such as bonds. If you are more comfortable taking risks, you might consider a larger proportion of stocks in your portfolio. It's important to find the right balance between risk and return based on your personal situation and financial goals. I don't think people understand asset allocation. Asset allocation is about dividing your money between different asset classes based on your financial goals, time horizon, and risk tolerance. For example, a young investor with a long time horizon and a high risk tolerance might choose to have a larger portion of their portfolio in stocks. On the other hand, an investor nearing retirement with a low risk tolerance might prefer a larger allocation to bonds and cash. Asset allocation is a personal decision that should be reviewed and adjusted regularly as your situation changes. Are you worried about maintaining your investment strategy over time? Once you have built your portfolio and set your asset allocation, it is important to rebalance it regularly. Over time, the value of your investments will fluctuate, which can change your initial asset allocation. Rebalancing involves selling assets that have performed well and buying assets that have underperformed to return to your target allocation. Rebalancing helps maintain an appropriate level of risk and optimize the long-term return potential of your portfolio.